Hello and welcome to BloombergQuint. My guest today is Rajesh Gopinathan, MD and CEO of TCS. Rajesh, thank you very much for joining us on BloombergQuint. To begin with, what kind of demand environment are you seeing going forward in the first and second quarter?
Well, good morning, and thank you for inviting us. First of all, let me wish all of your viewers and all your team in Bloomberg a very safe and healthy, auction. Um, Coming to the demand environment, the demand environment is very weak across the board, and primarily it is coming from a lot of uncertainty in terms of what the near-term scenario is likely to look at. Almost nobody has a good anchor to plan on. And that is one of the biggest issues that you're seeing across. So people don't know exactly how to plan for a controlled shutdown or a controlled ramp up. In a scenario of such uncertain times, it is important that we create some markers and certain operating models with which we go ahead. So what we are looking at is that we are betting on the strength of and the kind of the order book that we have and the ongoing engagement that we have with customers to say that let's plan for demand recovery towards the end of the calendar year, which is what in our discussions with many of our customers, they are also broadly working with. There are nuances to it, but many of them are thinking that towards the end of the calendar year, so that we start looking at the next calendar year in a fresh perspective, is where the current situation is there. And that's the broad construct with which we are operating.
Rajesh, you spoke about the fact that Q1 and Q2 are going to be weak for you, and you see normalcy coming in the third quarter, and you may exit Q4 at the same revenue as Q4 of this year. If you pencil down those things based on the same impact that GFC had on you in the third and fourth quarter of FY9, we're looking at a sharp recovery happening in Q3. Are you penciling in any inorganic growth as part of this sharp recovery, or is it entirely based on organic outlook which you have as of now?
So we are in extraordinary times, and let me put it that we are banking on everything that is available on our table. So one, as I said, we have a certain set of deals. We are doing our best to try and see what we can do to execute on those and, if possible, accelerate some of that. We are banking on our customer engagements to try and ensure that the strength of our operating model comes through, and as we can and use that to participate in some amount of market share gains. We are banking on the strength of our services organization, the newer services that are more closely tuned to the current demand environment, and to further sharpen the digital service portfolio that we have had. And we are rolling out many scores of new services and looking at which are the ones where there is traction and engagement with the customers. And we believe that a lot of that side of the demand side, being able to address emerging demand will come through. Any form of vendor consolidation or other options, all of them are on the table. I think I mentioned to you yesterday that people think about us as being conservative, but it is, if you go back to our history, it is in the peak of the GFC crisis that we made our largest acquisition. So everything is on the table. We have always maintained that the right asset at the right price, we are always game. And we have the strength of the balance sheet to be able to participate in any emerging opportunities.
GFC crisis, we saw offshoring opportunity that came across to TCS. In the current crisis, do you see the same kind of opportunity coming across to you, or your new model of working from home, which you said a borderless work culture, will you be able to push it across to your BFSI client?
I believe that your question, if I were to step back and take it in a larger way, that is this operating model something that is here to stay? And I believe the answer to that is irrevocably yes. So think about it this way, that we have been on a journey of actually moving to a distributed operating model. First, you move in what we call the on-site offshore model. Then we move to what we call the global network delivery model. We have been also promoting a new model against where the market thinking was on what we called as the location-independent agile, incorporating agile delivery methodologies without having the need for co-location. Last couple of years, we have been significantly investing in and perfecting a model called as open agile delivery locations. So going away from the ODC model to what we call as the open agile delivery center. And this new model that we are now moving to, which we are calling the secured borderless workspaces, that is a logical evolution of the journey that we have been on. What is most important is it is not just about taking a machine and instead of keeping it in the office, keeping it at home. It is about extending the entire delivery governance infrastructure, the quality management systems, the governance, the monitoring systems, the work allocation systems, the security systems, all of it into a distributed asset base. And that requires a significant amount of rejigging. Because we have been on this path of location-independent agile and open agile workspaces, we had already done the core changes to our systems that is required to support this. So we've been able to extend that entire framework into this model. And which is why even with such a huge and such a rapid shift, our delivery quality has not at all dipped. And that is what is getting noticed and actually appreciated by many of our customers.
Is it easy to push through this kind of model to banking and financial services where a lot of regulatory restrictions are available?
Actually, there are two challenges there. One is the actual operational challenge, and the other is the regulatory challenge. The operational challenge is easier to address, whereas the regulatory challenge by its inherent nature requires a layer upon layer of approval. So even if you think about the banking industry's adoption of the cloud, there was technically or operationally no reason why it should not have been adopted. In fact, it is very well known that the security in a cloud environment is far superior to the security of your own data centers, and both the resilient security elements are much better in the cloud. But because of its inherent risk management systems and its inherent approach to a more conservative look to any new trends, the banking industry has been among the later ones to adopt technology, and for right reasons also. A similar kind of a situation exists in this kind of a setup, that while the technical fabric and the operational fabric that I described lends itself, we believe, to an even more superior experience in this kind of a model. But we expect that some of the more conservatively structured industries will probably take a bit more time to fully adopt it.
And does it also throw up opportunities in terms of cost saving for a company like you if you go for a diversified model like this in the future?
It is not, we are not seeing it from a cost perspective. We are seeing it from, again, if you take the analogy of a cloud, we are seeing it from the power of actually being able to rapidly move resources. So if you look at a cloud, the reason the cloud is a more efficient operating structure is because utilization is maximized and full productivity is achieved, and you move your most pressing problems to your most reliable resources, and you can move that dynamically without impacting any other process. And that is the operating construct that we are excited about, which will inherently be more efficient, but it is not based on a unit cost to unit cost. It is based on an aggregate scale-based efficiency, where we believe that we are well positioned to execute that.
You exited Q4 with the highest TCV, $8.9 billion, maximum coming in from retail and then followed by BFSI. Do you see this order backlog that you have now? There will be a pause maybe in Q1 and Q2 and gradually picking up those orders, or because the orders have already come in, will the execution be delayed because of the current uncertainty, or those are on line to give you a good boost by the time you ramp it up by second quarter or third quarter?
It's going to be a mixed bag. Some of them are programs where there is a significant amount of transformation and development work upfront, which is in our hands. And as we have greater capacity, or we have ability to try and see whether we can accelerate that and focus on that and move it forward. Some of them have actually a lot of dependency on downstream activities or other activities, which inherently we should be expecting that it will get a bit delayed. And because the entire network has to come together for it, including both the client as well as some other engagements that they might be doing. So it's a combination of all of it. Some amount in our control, a lot which has got other dependencies. But the more important thing is that if you can put differential assets on the ground to help through. The good news is, just like us, clients also technically have right now free capacity because of the fact that a lot of the other activities have come to an end. How do we channelize that free capacity? By putting a technology fabric, wrapping it around with a technology fabric is the challenge, and we are constantly looking at it. Yesterday, I gave an example of National Bond Gauge insurance company in US, where we have actually been able to entirely do an online town hall and kick off the transition. And their executives were very, very, enthused by what happened. And the extent of executive support for it also was very high, because they themselves, actually, as I said, are focused on trying to get this done, and they have the bandwidth available to focus their time and attention on it. So the good news is that there is multiple people with capacity available. The trick is, how do you link that capacity together to get work through? And that's actually our strong suite. And if you can stitch it together, we should be able to, put it to our advantage rather than sit back and wait for somebody else to solve the problem.
The entire assumption is based on the fact that the peak will happen in April to June, and then it will be maybe a flattish quarter, and then you go to normalcy. What is the scenario in case some of the key geographies like a US or a Europe, the peak happens in the second quarter, because we are still seeing US adding a lot of COVID cases, Europe adding a lot of COVID cases. Your main market UK is also under siege with COVID. If this gets pushed by another 2-3 months, do you have a plan in place so that you still maintain that outlook?
So Sajit, I've been very careful to reiterate again and again, and I want to do it now. What we are providing is not a guidance. What we are providing is, we are sharing with all of our stakeholders that what is the operating assumptions under which we are currently operating. If events on the ground turn around and we have to change those operating assumptions, we will come back and talk about it. The good news is that our ability to withstand a further shock or an elongated shock is very high. It will have implications on the financial model that I spoke to you about, but our ability to withstand it is very high. So we don't have to be in a panic situation in terms of if suddenly this were not to come through. And the other good thing is that we are not incrementally adding capacity other than what we have already committed. So if the demand environment turns out to be much weaker than the scenario that I have laid out, we will just have to make sure that further capacity addition is no longer done. And we just stick with our capacity and ride it out till our utilization comes back to where we are comfortable with. So there are inherent strengths to our operating model. The most important thing in all such cases is you don't leave stranded inventory or stranded capacity. And by making sure that this technology fabric and model is in place, we can very rapidly shift capacity to wherever the opportunity is. And that is the operational excellence and the delivery and execution capability that we have. And meanwhile, from a sales perspective, we are fully engaged in the field so that both to sense and to capitalize on opportunity as it emerges. And wherever that opportunity comes, we have the ability to put capacity behind that.
No, so when you gave this, it's not a guidance, but it's maybe a outlook on what kind of scenario you're looking at. Have you penciled in the fact that you may have to compromise on your margins in this year because of the kind of demand situation or supply constraints that may hit you in the first 2 quarters? Are we going to see the same kind of margins which we saw at the end for the entire FY20, or there may be some kind of sacrifice that you may have to do on margins going forward?
Sajid, it's the same thing as on the revenue side. So the margin is just a second part of it. So as the model that we're working with is, we started dropping off on revenue. We were at 39,000 crores in Q3, and we started dropping off on that. And we expect that there'll be a huge drop off. And the idea is, can we get back to 39,000 crores by December quarter? Similarly, our peak margins in the current scenario is 25.1, where we are today, this quarter. And we expect it to drop off sharply next quarter. Can we get back to 25.1 by the time we get to Q4? So these are the two markers that we are using in the way we are planning and the way we are going about it. And we believe that that is a reasonable planning or scenario that we can work with. And that's one that we are executing on. What happens in the middle is very difficult to quantify currently. But as long as we can actually try to get back to where we left off, then we can continue our journey. So take a 3 to 4 quarter break and get back and continue. And that's our best guess of where we are currently.
Rajesh, is going to be two tough quarters for our entire industry and for companies like you. Wishing you all the best for the next few quarters. Thank you very much for joining us on BloombergQuint today.
So it's a pleasure always talking to you, and thank you for all of your support and encouragement. And again, wishing all of you safety and health. Thank you.
Thank you.